Imagine a superpower. Not a country with borders or armies, but an economic leviathan that sits silently at the center of the global map. If this entity were a nation, it would boast the third largest GDP on Earth, is economically bigger than the industrial might of Japan, is bigger than the economic engine of Germany, but you won't find it on any map. It is not a country. It is a company. Meet BlackRock. As of today, they manage over $14 trillion in assets. That is a 14, followed by 12 zeros. To put that in perspective, that is roughly 50% of the entire GDP of the United States in 2025, or 80% of the GDP of China. A number so astronomically large, the human brain struggles to comprehend it. But they don't just have money. They have control. Look at the phone in your hand right now, the car parked in your driveway, even the soda you drink or the news you watch. Chances are, BlackRock is the top shareholder in the company that made it. They are everywhere yet nowhere. Apple, Microsoft, Amazon, Google, Tesla. Pull up the shareholder list of almost any major corporation in the S&P 500, and you will see the same pattern. You'll find two names locked at the very top, BlackRock and their only real rival, Vanguard. Together with State Street, they are known as the Big Three. But BlackRock is the alpha. Combined, they own a significant piece of, well, the entire civilized world. Yet, most people walking down the street have never even heard of Larry Fink, the man who runs the show. He isn't a politician. He has never campaigned for votes. But his influence eclipses most world leaders. When the global economy melts down, when the markets panic, when the Federal Reserve needs a lifeline, they don't call the President of the United States. They call Larry. We saw this in 2008. We saw it again in 2020 during the pandemic. The government handed BlackRock the keys to the Treasury. Some insiders call it the fourth branch of government. Others call it a monopoly on the future. But the terrifying question is, how did we get here? How did a company that started in a tiny office just 35 years ago quietly conquer Wall Street without firing a single shot? How did they outsmart the legacy banks like JP Morgan and Goldman Sachs? This isn't a conspiracy theory found on a dark web forum. This is a documented story about financial machinery. It is a story about a supercomputer named Aladdin that sees every trade before it happens, and a boring investment philosophy called passive investing that accidentally broke capitalism. To understand how they own the world, we first have to understand the trauma that created them. We have to go back to 1986 to witness how one man lost $100 million and swore never to let it happen again. The year is 1986. It is the era of the Big Bang in finance. Wall Street is booming, cocaine is common in the bathrooms, and greed is good. And at the investment bank First Boston, a young, ambitious star named Larry Fink is standing on top of the world. Fink was a legend at the bank. He was instrumental in inventing a new financial product called mortgage-backed securities, or MBS. Basically, taking thousands of home loans, bundling them together, and selling them as bonds. It was a gold mine. He added $1 billion to the bank's bottom line. He was the golden boy, on track to become the youngest CEO in history. But Wall Street is a cruel teacher. Larry's department made a massive bet. They bet that interest rates would stay stable. They didn't have computers to model the risk properly. They just had gut instinct and basic spreadsheets. But the market doesn't care about your gut. Interest rates dropped unexpectedly. Homeowners rushed to refinance their loans to save money. They paid off their old mortgages faster than anyone predicted. The specific hedges Fink had set up failed spectacularly. And just like that, in a matter of weeks, First Boston lost $100 million. Gone. Vaporized. It was the kind of loss that ends careers. Fink went from a hero to a social pariah. He described it later as the darkest period of his life. Nobody looked him in the eye in the elevator. The people who cheered him yesterday ignored him in the hallways today. Eventually, he was forced out in disgrace. But this humiliation, this total public loss of control, broke something in him. It also rebuilt something. Most traders would have quit and bought a bar in Florida. Larry Fink got obsessed. He realized that Wall Street was flying blind. Everyone was gambling without knowing the real odds. He realized they needed a system, a way to see the risks that human intuition missed. He didn't want to build a company to just make money. He wanted to build a machine to stop losing it. So, in 1988, he teamed up with Stephen Schwarzman at Blackstone. He started a small shop in a one-room office. Originally called Blackstone Financial Management, it later spun off to become BlackRock. His pitch to clients was revolutionary in its boredom. He didn't promise the highest alpha or the biggest returns. He promised safety. He promised he would understand the risk better than anyone else in the room. He promised he would never be blind again. To keep that promise, he needed a weapon. He hired a team of mathematicians and coders, not just traders. He needed a computer that could simulate the future. He began to build the central nervous system of modern finance, a system he called Aladdin. Aladdin. It sounds like a fairy tale, but the acronym is purely technical. Asset, liability, debt, and derivative investment network. It is a boring name for perhaps the most powerful piece of software ever written. It is the brain of BlackRock. Before Aladdin, investment banks were drowning in messy paper trails. A bond desk in London didn't know what the equity desk in Tokyo was doing. They didn't know their total exposure. Aladdin changed that. Think of it as a global X-ray machine for money. It digitizes everything into one central dashboard. It scans the markets 24 hours a day, 7 days a week. But its real power lies in Monte Carlo simulations. Imagine rolling a pair of dice 5,000 times to see every possible outcome. Aladdin does that for the global economy. It asks what if, constantly. What if inflation hits 10%? What if a war starts? What if a pandemic shuts down the world? By stress testing every portfolio against disaster, it gave BlackRock a massive strategic edge. While other banks were guessing and trying to react to news, Larry Fink had a weather map. He could see the storm forming on the horizon before the first drop of rain even fell. This risk management became their core product. But here is the genius pivot that scaled the company. In the late 90s, Fink decided not to hoard this weapon. He decided to sell access to it. He transformed BlackRock from just an asset manager into a technology company. He started leasing Aladdin to everyone. Today, the client list of Aladdin reads like a who's who of the global economy. It doesn't just manage BlackRock's money. It manages money for their fiercest competitors. Vanguard uses it. State Street uses it. Major insurers uses it. Even the pension funds of California and Japan use it. It has become the operating system of capitalism. Estimates suggest that Aladdin monitors over $20 trillion of assets worldwide. To put that in perspective, that is roughly equal to the GDP of the United States. All that wealth sitting on one platform. All those decisions relying on one single algorithm. One set of eyes watching the world. This creates a strange and dangerous paradox called herding. If everyone uses the same risk model, do they all react the same way when panic hits? If Aladdin flashes a red light and says sell, does the whole world sell at the exact same second? We have created a synchronized market. We don't know for sure because the code is a secret. But we do know that by 2008, BlackRock had positioned itself perfectly. They weren't just a player in the game anymore. Because they owned the data, they were becoming the referee. The only ones who knew the rules. And when the housing market collapsed and Wall Street caught fire in the great financial crisis, the phone in Larry Fink's office started ringing. It wasn't a client. It was the U.S. Treasury. They didn't know how to fix the mess, but they knew Larry's computer could. September 2008. The financial world is ending. Lehman Brothers has collapsed. Merrill Lynch is being sold for parts. The insurance giant AIG is hours away from bankruptcy. Panic is spreading like a virus through the veins of the global economy. The credit markets, the lifeblood of capitalism, have frozen completely. In Washington, D.C., the Federal Reserve and the Treasury Department are flying blind. They know the banks are holding billions of dollars in toxic assets, complex subprime mortgage derivatives that have become worthless. But the government has a problem. They don't know which banks are holding what. They lack the data. They lack the software to untangle the mess. So Treasury Secretary Hank Paulson makes a desperate phone call. He doesn't call a rival bank like Goldman Sachs or Morgan Stanley because they are all drowning. He calls the one man who claimed to have a map of the minefield. He calls Larry Fink. The government hires BlackRock to manage the bailout of Wall Street. Specifically, they hired a unit called Financial Markets Advisory. Their job was to analyze the toxic waste of Bear Stearns and AIG. They were given the keys to the kingdom. BlackRock was now responsible for valuing and selling off the assets of its own competitors. Think about the power dynamic shifts here. It was a conflict of interest so massive, it was visible from space. How could a private company which invests in banks also be the government auditor regulating those same banks? Critics screamed that BlackRock was seeing proprietary data from its rivals. They were looking at everyone's poker hand while sitting at the table playing the game. But Washington didn't care about the ethics, they cared about survival. They needed Aladdin. They needed someone who could see through the fog of war. And BlackRock delivered. They successfully unwound the positions. They helped stabilize the U.S. economy. The maiden lane, vehicles they managed eventually paid back the taxpayers. But the payment they took wasn't just in fees. It was in prestige. By the time the dust settled in 2009, BlackRock was no longer just another asset manager. They had become the shadow government of finance. They were the go-to problem solvers for world leaders. From the European Central Bank to the Bank of Greece, when a country was in trouble, they called BlackRock. They had won the crisis. They had solidified their reputation as the adults in the room. Now, they were ready to win the recovery. And their next move would be to ride a new wave that was sweeping the investment world. A boring, passive revolution that would turn them into giants. While Larry Fink was building his supercomputer in New York, another revolution was happening quietly in Pennsylvania. It was led by a man named Jack Bogle. Bogle was the founder of Vanguard, and he is the patron saint of the everyday investor. He hated Wall Street greed. And he had a radical, simple idea. For decades, investing meant paying a guy in a suit high fees to pick stocks for you, to find the winners. Bogle looked at the data and said, "This is a scam. Most experts fail to beat the market average." So he said, "Don't look for the needle in the haystack. Just buy the haystack." This was the birth of the index fund. Instead of betting on Apple or Ford, you just buy a tiny piece of every single company in the S&P 500. It requires no research, no experts, and most importantly, almost zero fees. Wall Street laughed at him. They called it Bogle's folly. They said it was un-American to be average. But Bogle was right. Over time, passive funds started beating the active managers. And then the floodgates opened. Investors realized they were wasting money on fees. Trillions of dollars began to migrate from active hedge funds to passive index funds. It was the greatest migration of wealth in history. BlackRock saw this wave coming. Larry Fink realized that Aladdin alone wasn't enough. So in 2009, he made the deal of the century. He bought a company called iShares. Overnight, BlackRock became the king of ETFs. Suddenly, BlackRock and Vanguard weren't just banks, they became the vacuum cleaners of the stock market. The mechanism is automatic. Every time you get a paycheck and put money into your 401k, every time a teacher contributes to a pension, the system automatically buys index funds. That money flows directly into BlackRock and Vanguard. They don't have to sell anything. The structure of the modern economy forces you to give them your money. But here is the catch that nobody noticed until it was too late. When you buy an index fund, you own the financial return, but BlackRock keeps the voting rights. You supply the capital, they wield the power. It's the greatest magic trick in corporate history. Imagine owning a house. You pay the mortgage, you fix the roof. But your neighbor gets to walk in and decide what color you paint the walls and who lives in the spare room. That is the situation we are in. We own the companies, but they control the boards. Because BlackRock and Vanguard buy everything in the index, they end up owning everything. This leads to a bizarre phenomenon in capitalism. Let's take a walk down the soda aisle of your local supermarket. You see Coke and Pepsi, the ultimate rivalry. Red versus blue. They have been fighting for your dollar for 100 years, right? Well, look closer at the shareholder registry. The top shareholder of Coca-Cola is BlackRock and Vanguard. The top shareholder of PepsiCo is also BlackRock and Vanguard. They are the largest owners of both sides of the war. And this pattern repeats in almost every industry. Delta Airlines and United Airlines? Owned by the Big Three. Ford and GM? Owned by the Big Three. CVS and Walgreens? Same story. This is what economists call common ownership. And it changes the fundamental incentives of capitalism. Think about it. If you are the owner of a football team, you want to crush your rival. But if you own both teams in the Super Bowl, do you really want them to fight to the death? Do you want them to spend millions on better players to beat each other? No. You want them to play nice. You want them to keep ticket prices high. You want them to cut costs and maximize total profit for you. Economists argue that common ownership softens competition. Why lower ticket prices to steal a passenger from United if your main shareholder owns United too? It's like stealing money from your left pocket to put it in your right. There's academic evidence suggesting this actually happens. Studies have shown that in industries with high common ownership, prices for consumers are higher. Airline tickets cost more. Bank fees are higher. Innovation slows down. The fierce competition that drives capitalism forward starts to stagnate. Now, to be clear, BlackRock doesn't send illegal emails ordering CEOs to fix prices. That would be a crime. They don't have to. The CEOs are smart. They know who signs their massive paychecks. They know that if they start an aggressive price war that hurts the portfolio, Larry might not be happy. For years, Larry Fink argued that they were just passive observers. He claimed they didn't interfere in company management. He said, "We are not the owner, we are just the custodian." But recently, that narrative has started to crack. The sleeping giant has woken up. Every January, Larry Fink writes an annual letter to the CEOs of the world's largest companies. For years, these letters were standard corporate fluff. But a few years ago, the tone changed. Fink started talking about more than just profits. He started talking about purpose, about stakeholder capitalism, and most controversially, about climate change. He introduced a new metric that would terrify boardrooms everywhere: ESG, environmental, social, and governance. It was a scorecard. Fink explicitly warned companies, if you don't have a plan for net zero carbon emissions, if you don't diversify your board, BlackRock might use its massive voting power against you. We might vote to fire your directors. This was a seismic shift. The passive observer was becoming an active enforcer, and it ignited a political firestorm in the United States. On the right, conservative politicians were furious. They accused BlackRock of playing politics with other people's money. They branded it woke capitalism. The argument was simple. You are managing the pension funds of oil workers in Texas. How dare you use their money to force companies to stop drilling for oil? You are using our pension money to push a liberal agenda that we never voted for. It became a culture war. The backlash was real. Several Republican-led states, including Texas, Florida, and West Virginia, publicly blacklisted BlackRock. Texas and Florida pulled billions of dollars of state pension funds out of BlackRock's management. They declared war on Larry Fink, calling him the enemy of the fossil fuel industry. But here is the irony. While the right was attacking him, the left was attacking him too. Environmental groups screamed that ESG was a scam. They pointed out that BlackRock is still one of the largest shareholders in ExxonMobil and Chevron. They accused Fink of greenwashing, talking about saving the planet while profiting from its destruction. Larry Fink found himself trapped in the middle. He argues that he is just a capitalist, not an environmentalist. He says, climate risk is investment risk. If the world burns, the economy collapses. Therefore, forcing companies to go green isn't politics, it's just good long-term math. But the deeper question remains. Regardless of your politics, should one unelected CEO have this much power? Should a single man in a Manhattan tower have the leverage to reshape the global energy grid? Is that democracy? Or is it a new form of corporate feudalism? If you think BlackRock's influence stops at the corporate boardroom, you are mistaken. The line between BlackRock and the White House has become so blurred, it has practically vanished. In Washington, they call it the revolving door. You work for the government regulating the banks, then you quit and take a high-paying job at the bank. Or vice versa. Goldman Sachs used to be famous for this. They called it government Sachs. But today, it might as well be the United States of BlackRock. The circular flow of personnel is staggering. Let's look at the Biden administration as a prime example. Take Brian Dees. He was the global head of sustainable investing at BlackRock. He helped write those ESG letters. Then, he moved straight into the White House to become the director of the National Economic Council. The man shaping U.S. economic policy came directly from Larry Fink's payroll. Or look at Wally Adeyemo. He served as Larry Fink's chief of staff, the right-hand man to the CEO. Where is he now? He is the deputy secretary of the Treasury. The relationships run deep. And it goes the other way too. When Thomas Donilon retired as Obama's national security advisor, he walked straight into a job as chairman of the BlackRock Investment Institute. Why does this matter? It matters because the people writing the rules and the people playing the game are often the same exact circle of friends. It creates a feedback loop where government policy and BlackRock's corporate strategy become aligned. When the next crisis hits, and it will hit, who will these officials save? Will they save the taxpayer? Or will they save their former colleagues and future employers? When the government needed to buy corporate bonds in 2020 to save the market, they hired BlackRock to do it. And guess whose ETFs BlackRock bought? Their own. This blurs the line between the state and the market. It suggests that BlackRock isn't just a company anymore. It is a permanent institution. Presidents come and go. Political parties rise and fall. But Larry Fink stays. He is the permanent fixture in the room. This level of consolidated influence is unprecedented in financial history. Not even J.P. Morgan in the early 1900s had this kind of global reach. And there is a simple reason for that difference. Because J.P. Morgan didn't have the technological power of Aladdin. He was limited by human speed. Fink is not. Now, before we conclude that BlackRock is the villain of the story, we have to be intellectually honest. There is a critical detail that conspiracy theorists often ignore. We keep saying BlackRock owns $10 trillion, but technically they don't. That money doesn't belong to Larry Fink. It belongs to you. It belongs to the pension fund of that retired teacher in Ohio. It belongs to the firefighter's 401k in New York. It belongs to your grandmother's saving account. BlackRock is an asset manager, not an asset owner. They are a fiduciary. That is a specific legal term. It means they are required by law to maximize profits for their clients, not for themselves. If Larry Fink started sabotaging companies just for fun or playing political games that actually lost money for his clients, he would be sued into oblivion. He has a legal gun to his head to make money. So in a way, BlackRock is just a mirror. It reflects the collective desire of the world to retire safely. We gave them the money because we wanted low fees and safety. They grew big because we wanted them to grow big. We voted with our wallets. However, while the money belongs to us, the power belongs to them. This is the separation of ownership and control. It is the fundamental flaw of modern capitalism. The millions of people who take the financial risk don't have a say in how the companies are run. The voting rights are concentrated in the hands of the few. When it's time to vote on a massive merger or a CEO's pay package, the teacher in Ohio doesn't get a ballot in the mail. Larry gets the ballot. He speaks for the money, even if the money doesn't know what he is saying. BlackRock is aware of this criticism. Under pressure, they have launched voting choice programs. They are starting to let some big institutional clients cast their own votes. But for the vast majority of retail investors like you and me, the power remains centralized. So the problem isn't necessarily corruption. The problem is structural. We have built a financial system that naturally trends towards monopoly. Efficiency demands scale, and scale creates power. We have to ask ourselves if we are comfortable with that trade-off. We have decoded the machine. We trace the arc from a young trader's failure in 1986 to the creation of the all-seeing eye of Aladdin to the passive revolution that vacuumed up the world's wealth. It is a remarkable story of American ingenuity and survival. BlackRock isn't a villain in a comic book. They are simply the ultimate winners of the game we all agreed to play. They are efficient. They are safe. They are the logical conclusion of a system that prioritizes optimization above everything else. But there is a price for perfection. We wanted low fees. We got them. We wanted steady returns without doing any work. We got them. But the price we paid was centralization. We handed the keys of the economy to a benevolent dictator. We have created a financial leviathan, a force so massive it has its own gravity. It bends markets. It bends governments. It bends the future of energy and climate. And like any singularity in physics, it represents a point of no return. The danger isn't that Larry Fink has a secret, evil plan to destroy the world. The danger is systemic risk. We have put all our eggs in one basket, and we have handed that basket to a single algorithm. If everyone is relying on the same risk model, what happens when the model is wrong? If Aladdin breaks, if the code is a blind spot, the crash won't just be a market correction. It could be a systemic failure that no government can bail out. Because this time, the government's rescuer will be the one needing rescue. Perhaps it is time to rethink passive investing. To realize that being passive means giving up control. Maybe it is time to wake up and take the wheel back. To remember that capital is power. And democracy requires power to be distributed, not concentrated. Because if we don't control our money, someone else will. And they might not have our best interests at heart. BlackRock owns the world, only because we let them. In a world owned by algorithms, do you want to be a user? Or do you want to be an owner? This story about BlackRock forces us to confront a difficult trade-off between efficiency and control. So I want to ask you a question. Do you think the stability provided by these massive index funds is worth the risk of centralized power? Or is it time for the government to step in and break up the big three? I am genuinely curious to hear your perspective on this. Leave your thoughts in the comments below. If you found value in this investigation and want to support more deep dive documentaries like this, please consider subscribing and turning on notifications. It helps us continue to decode the hidden logic of our world. Thank you for deep thinking with us.